I can hear. Okay, okay. You know what? Should I give you guys some sauce? Should I give you guys some? Should I tell you guys what I've been testing? I'm an open book with you guys. Okay, I'm an open book with you guys. I already gave you guys some hints in the Discord with like the level that I was potentially watching, and another Lars also guessed it. But what I was searching, right? What I was searching was, let's say it's called a DBI. Okay, it's called a DBI. Let's say you have a fair value gap here. Okay. Let's say you have a fair value gap here. Pretend that these are candles. Okay, we're not gonna make it pretty, but pretend like these are candles. And in these candles, you left a fair value gap. And this block represents the fair value gap. Now, normally you have people that, you leave a fair value gap, they try to trade the reaction of the fair value gap. But instead of that, you actually reverse the fair value gap, leaving another inefficiency. Okay? So you slice through the fair value gap with an inefficiency. When you tell this to futures traders, they call this an inverse fair value gap. A lot of futures traders, they trade inverse fair value gaps. This is nothing that I created, okay? For value gap creation, you slice through it with another imbalancy, boom, inverse fair value gap, and you trade the reaction away from it. But what if, yet again, that inverse fair value gap gets another inefficiency push up? We know, in general, that the more the inefficiency, the stronger the reaction. It's with everything. The market loves to fix inefficiencies. It loves to fix mistakes. So the more mistakes in a certain point, the harder the reaction away from it is going to be, based on the fact that the market loves to fix things, okay? So I was like, okay, what if I have like an inverse fair value gap? Will we push through it even more? And that's why I called this, for now, the DBI. Right here, DBI. And the DBI stands for a double breaker inefficiency. So you have the fair value gap, and then it becomes a breaker fair value gap or an inverse fair value gap, but then you break it once more. So it's a double breaker. You break it, okay? So double 1-2 breaker inefficiency. And then when you bounce from it, the reaction tends to be very strong. But then what I figured out, is that in general, the EQ of a fair value gap is the strongest, right? The EQ of the fair value gap tends to be the strongest. And this is also a theme that's already more known, okay? It's already more known. So what if we focus on that EQ? What do we get? Do we react perfectly off the EQ? Life example. What do we have here? A fair value gap, okay? This is the fair value gap. What happens here? We slice through the fair value gap once. What happens here? We slice through the fair value gap twice. Let's extend it. Where did you react? The E motherfucking Q of the DBI. I'm telling you, I've seen it so many times. And you know what's the most beautiful thing? You know what's the most beautiful thing? We had a range here. Okay? This range was already a confirmed accumulation with a 1, with a 2, with a 3 right here. So you have a Model 2 accumulation schematic that is already confirmed, okay? So you have a Model 2 accumulation schematic that's already confirmed. You have a return to zone right here. And I'm seeing this right now as we were talking about gold. What does price do? Price ends up coming back for yet again extreme liquidity, right here, if we have to measure extreme liquidity from the move, we're just going to use this candle, okay? It's the extreme liquidity from this entire move up that we had. And price swept it here. Just showcasing that there's even more market maker involvement in the chart. You know? They're truly grabbing all sell side liquidity, sweeping all sell side liquidity, leaving buy side liquidity above. You guys know the thing, right? Model 2 accumulation, extended Model 2 accumulation, return to zone above, 100% a long opportunity. Okay? But normally, we would have to wait for a market structure break, this and that, and you would enter somewhere here and you put your stop loss below the low, and you have an amazing 2.5 risk to reward, right? But what if we have all the data on levels like this right here, where we can enter on the fucking reaction of it, put the stop below the fair value gap, below the DBI, and then catch these motherfucking trades? A 20 RR. My G. This could be insane. This could be absolutely insane. Right? And I've seen it happen multiple times. So this is what goes on behind that went through everything. And look at the reaction. Not from the EQ this time, right? Not from the EQ. BI. Boom. Perfect. And then look right here. Guys, look at this. 18 hour. What can you see right here? Fair value gap creation. We slice right through it. Once. Twice. Come back. EQ touch. Like, you cannot convince me that the market isn't ran by straight up algorithms. Because then look at look down here.